Well, we knew it was coming. And now the crypto crash is finally here. Those investors who claimed they'd never touch the fake money are laughing at the collapse. They're wagging their fingers, snidely saying, "I told you so." The believers, on the other hand, are having their faith tested once again. But is this the end of the road for Bitcoin, Ethereum, Dogecoin, all the rest? Or is there a second chance for profits? Hi, I'm Matthew Carr, Chief Trend Strategist at the Oxford Club. Thank you for watching this episode of Market Trends. If you're new here, be sure to hit that subscribe button and turn on notifications so you never miss out on my best trading ideas, which I share here each and every week. Now, it's been a difficult run for crypto markets in recent weeks. You don't need to look any further than all the YouTubers posting sad, exaggerated faces about their imploding portfolios. Some are pleading and feeling betrayed by their messiah and Doge father, Elon Musk, particularly as the crypto space has been crashing back to earth ever since he hosted Saturday Night Live on May 8th.
Okay, but what is Dogecoin?
Well, it was created in 2013 and has a circulating supply of 117 billion coins, of which 113 billion have already been mined.
Right, cool. So what is Dogecoin?
But in reality, the pain began a couple weeks before that. Since topping out at $64,000 in mid-April, Bitcoin shed more than half of its value, tumbling all the way down to $30,000. It's bounced back some as $30,000 is acting as support and $40,000 is currently acting as resistance. And we've seen Bitcoin pull back and hold at this $30,000 level earlier this year as well, back like in January. Meanwhile, we have the Bloomberg Galaxy Crypto Index. Well, it's been in freefall since May 11th. So what's happening here? Well, this is the perfect example of the two phases of kind of an overheated market. Think of it like a sugar rush and the resulting crash. Do I think cryptos are done? Not by a long shot, but this is when the jokes start to die. What we've seen in crypto is the classic rising tide lifts all boats, but the leaky ones eventually sink. When there's a lot of excitement about an investment, and that investment is performing exceptionally well, everything in that sector starts to take off. This creates a situation where investors are driven by FOMO, fear of missing out. It can get pretty fun, pretty funny, and actually really quite profitable. Though it's also exceptionally dangerous. In this type of cycle, early investors do the best. They do extremely well. But then the tone of the market shifts. Those early investors start cashing out, and the mood moves from FOMO to FOLM, FOLM, fear of losing money. That enthusiasm and euphoria begins to moderate. And instead of buying every hot new token under the sun, investors become more selective, focusing on quality and value. The exact same trend happens in stocks. In fact, we can see this playing out right now with the tech sector's struggles this year. Now, for cryptocurrencies, there's another thorny issue investors have to contend with, and that's the overheated market draws the attention of regulators. At the moment, Bitcoin miners are dealing with a crackdown in China, and in the US, Federal Reserve Chairman Jerome Powell said greater regulation of cryptocurrencies is warranted. This is something that we've heard many times before. These situations always ignite profit taking, which combusts into panic and then explodes into an outright crypto crash. And that's what we have right now. So what should investors be doing right now? Well, first, I wouldn't be tripping over myself to snag shares of Chinese crypto miners like Canaan or eBank International Holdings. China appears intent to push crypto mining and trading to outside of its borders. Here's the deal though. Investors want and should have exposure to cryptos. This asset is undeniably generating some of the largest returns over the past decade, though also suffers from some of the greatest volatility. I believe right now it's prudent to start shifting away from moonshots to being more heavily weighted in better established cryptos. That means focusing on Bitcoin, Ethereum, and Litecoin, as well as stable coins such as Binance Coin and Tether. In the past, I've outlined the sector. The crypto sector moves in waves. Essentially, we see a 2-year bull market followed by a 2-year bear market. I've actually covered this here on this channel. This largely has to do with reward halving of Bitcoin. Now, the current rally peaked on April 15th, and that gave us a gain of 635.9%, right? That's since the last halving, May 11th of 2020. If that top holds, that'd be the smallest and shortest, a mere 339 days, a bull market following a reward halving yet. Regardless, we have to accept that the fun part, or the funnest part, is over, at least for now. We have support at $30,000 and it's holding, and we're going to be entering a more focused stretch. FOMO is being replaced by FOLM, FOLM, and the pressure's on to see if there's one last run to new all-time highs in the next 6 months or so. I'm not sure this current bull is completely at rest yet, but there are signs it's getting winded. Well, I'm Matthew Carr, Chief Trend Strategist at the Actual Club. Thank you for watching this episode of Market Trends. For more information like this, be sure to go down to the description and sign up for my free e-letter. Until next time, here's to high returns.